Previously, we talked about some of the reasons why people invest in the stock market. All these reasons can be summed up in two words: increased wealth. This happens only if the price of your investment moves higher. This is why the importance of trend trading cannot be underestimated. Although simple in concept, trend is a powerful trading tool for stock market investors. What is trend? The trend is the general direction of price. There are two directions, up or down. A sideways market is a trendless market. The most essential tools used by the chartist, trend lines, support and resistance, and moving averages all have the main purpose of identifying the trend. So we will discuss these tools in this section. Let's start with trend lines. In this illustration, we see a series of price highs and price lows. The price lows are connected to create a trend line. This trend line is moving higher. So this is an uptrend line, which is also called a demand line or the diagonal support line. In an uptrend, the demand is increasing even as the price rises. This is bullish. Previously, we talked about one of the strategies to make money in the stock market, which is to buy high and to sell higher. This strategy is used in an uptrend. So as long as price is on an uptrend, the rewards are higher than the risks. This is Ayala Corporation's price chart from March 2021. The initial higher price lows 1 and 2, when connected, formed an uptrend line. The higher lows that followed respected the uptrend line as support and used it as a bounce-off point. Here we see that instead of the price lows, it is the price highs that are connected to create a trend line. So these price highs are moving lower. So the price is on a downtrend. The downtrend line is also called the supply line. In a downtrend, the net supply is increasing even as prices decline. This is bearish. So even if prices are lower than before, the market is not necessarily buying immediately because prices can even go lower. This is why you would not want to enter a stock that is on a downtrend. The risks are higher than the rewards. This shows the Alibaba Holdings price chart from November 2020. Remember, we showed this earlier. This was when the prices started to drop from the highs. So the initial lower price highs 1 and 2, when connected, formed a downtrend line. The lower highs that followed respected this downtrend line as resistance. They used this as the bounce-off point on the way down. So the downtrend line served as resistance to price that pushed prices downward. In this chart, we see that the prices move towards common highs and common lows. There is an absence of trend, so this is moving sideways. A line is drawn across the highs to create the horizontal resistance line. A line is also drawn across the lows to create the horizontal support line. This is also called a trendless market. Stock prices usually go into a sideways movement within a trend. For example, if price is going up, it will tend to rest for a while and move sideways before resuming its trend up. Or stock is going down, it will move sideways first before continuing to go down. Sideways markets are also present when price is about to reverse. So we'll talk about this in this section as well. So here's an example of a sideways market. The price of BlackRock Inc. moved towards common highs and common lows from March 2021. So price traded within a range, defining the horizontal support and resistance lines. So there can be many trends inside a trend. We have inner and outer trend lines within any trend. This is the price chart of Hello Group Inc. from the Nasdaq. This shows the inner and outer trend lines, which correspond to the long-term, medium-term, and short-term trend lines. The price is currently on a downtrend. The outer trend line is the long-term trend line, shown here with the red line. So it has a larger time frame and connects the major price swing points. The medium-term trend line is an inner trend line. It has smaller price swings. It's shown here in the blue line. The short-term trend line also uses inner trend lines. This inner trend line has a shorter time frame than the medium-term trend lines. It has the smallest price swings. So both inner and outer trend lines serve as supports and resistances. When price breaks above the inner trend line, the next resistance is the outer trend line. So even if price was able to break above its short-term downtrend, it still has to face the medium-term or the long-term downtrend lines in order to create a trend reversal. When the inner and outer trend lines have a common resistance area and price breaks above that common resistance area, the result is a strong momentum move as shown here. Now here's another example of a chart showing the inner and outer trend lines. The orange lines are the inner trend lines representing short-term trends, while the violet line is the outer trend line representing longer-term trends. Trends change over time. A time frame refers to the amount of time that a trend lasts in a market. This chart is a zoomed out view of the NVIDIA price chart shown previously. This shows the bigger picture from March 2020 until January 2022. From March to September 2020, price was on a short-term uptrend indicated by the green inner line. Price then moved sideways from September 2020 until June 2021. This medium-term consolidation is shown by the orange lines moving sideways. So price broke above the sideways consolidation by June 2021 and then resumed its uptrend. This breakout is shown here with the blue arrow. Price peaked on December 2021. You can see that red circle on top, and then entered short-term downtrend shown by the red line. So the red line is an inner trend line. Even if the short-term trend is down, the medium trend shown by the green line and the long-term trend shown by the violet line is still moving upward. So trends exist within trends. While the long-term trend may be moving in one direction, the short-term or medium-term trends may be moving in the opposite direction. At the start of this presentation on trends, we saw a clean illustration of what uptrend, downtrend, and sideways movements look like. But we also saw in real-world charts of Hello Group, NVIDIA, and Alibaba that price does not move exactly in this way. This is why trading is not an easy task. Price can move erratically, and the reality is that price movements are far from what we expect. So our previous illustration shows us symmetrical lines and predictable highs and lows in terms of price and duration. So this is our expectation. But in reality, we are faced with uneven price highs and lows and unpredictable timing. So this is a case of expectation versus reality. What you ordered versus what you got. Let's summarize and reiterate what we just learned about trends. When the candlestick on a price chart are making higher lows and higher highs, then the price is on an uptrend. Draw a straight line to connect the bottoms of the candlestick bodies and not the shadows to create the uptrend line. Now, when the candlesticks on a price chart are making lower highs and lower lows, then price is on a downtrend. Draw a straight line to connect the tops of the candlestick bodies and not the shadows to create the downtrend line. Now, when the candlesticks on a price chart are moving sideways, then it is trendless. Draw a straight line to connect the tops of the candlestick bodies and the bottoms of the candlestick bodies to define the trading range. Here are illustrations of buying the dips and selling on strength. We only buy the dips in an uptrend, and we set a stop loss below the confluence of the trend line and horizontal support. So again, what is a confluence? It is a point of agreement where both the trend line and the horizontal support are located in this case. We set trail stops as price moves along the uptrend line. So trail stops are stop loss points, but they are trailing. They are moving along with the price. Remember that trail stops are only meant to be moved higher, not lower. So if suddenly the price drops, you do not move the trail stop lower. You simply cut loss when that trail stop is violated. We sell on strengths in a downtrend. When you are in a long position and price makes a bearish reversal and falls below the trend line, the trader could cut loss immediately or try to sell on strength. Selling on strength is a very difficult strategy to implement. So if you are a new trader, simply cut loss immediately once price violates your support. Some more experienced traders try to tranche their selling. Say there's a violation of support, they can sell 25%. When they see some strength, they can sell another 25% and another 50% once they are proven right about cutting losses. When there's a clear indication that the chart is getting bearish, then they get out of the trade entirely. This is why it is much easier to trade with a trend. The buying on dip strategy is much easier to implement than the selling on strength strategy. So go with the easy one. Trading doesn't have to be difficult. Now, here's an illustration of buying the dips in short-term and medium-term long trades. In a short-term long trade, the trader uses the confluence between the inner trend lines and horizontal support as stop loss. So you find the commonality. Where do they intersect? The place where they intersect is likely to be a strong support level. So in a short-term long trade, enter at the sign of reversal from the medium-term trend line. Set a stop loss below the confluence of the trend line and the horizontal support. And then exit or take profits at the break below the short-term trend line. In a medium-term long trade, buy on dips at the trend line, hold as price is above the medium-term trend line, and then set a trail stop as price moves along the upper trend line. So again, trail stops move along with the price. So again, you have to decide for yourself if you would like to do short-term trades or medium-term trades. This depends on how much time you have for the market, how fast you react to price moves, your investment objectives, etc. Now let's talk about support and resistance. Trend lines are diagonal lines that show the trend. In this section, we will use horizontal support and resistance lines to show demand and supply areas and possible bounce-off points for price. So let's talk about demand and supply. Let's assume that you pledge to donate to a community called Let's Roll, which aims to raise as much toilet paper for the local school. You only have a limited budget of $25 to buy 100 toilet paper rolls. So would you buy at a high-end grocery like Whole Foods, which sells at $1 per roll? Or would you buy at Walmart's, which sells toilet paper rolls at 25 cents each? So your volume required is 100 toilet rolls, and your cash allocation is $25. So you and your friends go to Walmart, but when you get there, you find a long line of people at the service counter waiting to get some toilet paper rolls. It seems impossible to get any fill of toilet paper because there is little supply and the demand is high. There was a long line of buyers and you did not want to spend hours in line. So you decide to go to Costco that sells toilet paper at a higher price at 30 cents each. You were only able to secure 10 toilet paper rolls until the supply ran out, spending $3 in total. Then you moved to the next store, CVS Pharmacy, where you got 12 rolls at 50 cents each, spending $6 in total. Dismayed, you end up at Whole Foods, which sold toilet paper rolls at $1 each. They have a huge supply of toilet paper to meet your needs, but since the price is high, your money only got you 16 toilet paper rolls, spending a total of $16. So this summarizes the amount you spent on toilet paper rolls. At Walmart, you spent 0 cents. There's low supply and high demand. At Costco, 10 rolls at 30 cents. It's right in the middle of the range, as well as CVS, where you got 12 rolls at 50 cents. At Whole Foods, you got 16 rolls at $1, totaling $25 for 38 rolls. So at stores where there is a high price, there is low demand, there's high supply. At stores where there's low price, there's low supply but high demand. This brings us to our toilet paper analogy on support and resistance. The retail store where there is the highest demand and the lowest price for toilet paper can be likened to the support area on a price chart. This is the price range where buyers line up with their huge volume orders. The support is the price level at which buyers are waiting to enter the market with sufficient volume to take control from the sellers. At the support area, the demand is greater than the supply. The retail store where there is a high supply and the highest price for toilet paper but very little buyers can be likened to the resistance area on a price chart. This is the price range where there is a huge supply for a particular stock and therefore the volume of orders is high. The resistance is the price level at which sellers are waiting to exit the market in sufficient volume to take control from the buyers. The supply is greater than the demand at the resistance area. The retail stores where the students bought 10 toilet rolls and 12 toilet rolls respectively have moderate demand. These price levels are found within the range between the support and resistance areas. So this is where buyers buy higher to fill their volumes when they are unable to fill their demand at the support area. So this is also the area where sellers sell lower in order to lighten on their supply of shares. So this shows resistance and support areas in an uptrend. In an uptrend, the high demand for shares pushes the price lows higher and the price highs higher. Both the support and resistance zones are moving upward. So previously we talked about buying high and selling higher. If the demand for shares is strong enough, this is not entirely impossible and is not necessarily a huge risk. In a downtrend, the high supply of shares pushes the price lows lower and the price highs lower. So both the support and the resistance zones are moving downward. This is also one of the risks in buying low because price can still keep going lower. Just because the stock price is low doesn't mean you're getting a bargain because it can keep going lower. In a sideways market, both the support and resistance zones are horizontal. So neither the demand nor the supply has the upper hand. They are currently in equilibrium. So why do sideways markets happen? It happens because the market has long memory. It remembers price levels where there is high demand and the price levels at which there is high supply. This chart shows the price of Ayala Corporation. It shows how the market revisited the same support and resistance levels many times over many years. Price had created horizontal channel from the price action in the past 10 years, which showed the dominance of buyers at the support line and the dominance of the sellers at the resistance line. This chart shows volume climax at support and resistance areas of the same chart. At turning points or reversal areas, there's above average volume. Notice that every time there is a sale at a department store, there are more people. When there are more buyers tend to get attracted to buy as well. So at the resistance area, this huge volume leads to buying exhaustion. The buyers have weakened and the sellers have been able to overcome the buyers. At the resistance area, the result is a retreat in price. At the support, there is selling exhaustion and high volumes. The sellers have weakened. When this happens, the buyers are able to overcome the sellers and the price rebound happens. In a sideways market, the bulls and the bears are moving within the trading range. However, inevitably, one of the two will emerge stronger. When the bulls are strong enough to push price up past resistance, a bullish breakout happens. The previous resistance becomes the new support. There is a role reversal. Now, in contrast, when the bears are strong enough to push price below support, a bearish breakout happens and the previous support becomes the new resistance. Again, this is a role reversal. This chart illustrates two important characteristics of the market: the market's long memory and the reversal of roles. Notice how price references previous support and resistance levels and how price bounces off the same levels in later periods. Now let's proceed with trend continuation and trend reversal. Let's start with trend continuation. So these diagrams show trend continuation. Trend continuation happens when the price successfully comes out of consolidation patterns and resumes the bigger trend. So the figure at the left shows a bullish breakout. Price was on an uptrend. Price moved sideways and then continued to break above that sideways pattern, continuing with its uptrend. So that's a bullish breakout. The figure to the right shows a bearish breakout. The trend was down. The price moved sideways and then price eventually broke below the support of that sideways pattern and continued downward. So this is a bearish breakout. Consolidation patterns are simply rest areas before price resumes with its bigger trend. So this is what you call trend continuation. Here's an example. The price chart of Tesla Corporation shows that price had been trading above the trend line. However, at point A, the price broke below that trend line, but rather than reversing into a downtrend, the price moved sideways. Even though price was trading below the previously established trend line, the demand at the support of the sideways range had been strong. Price made higher highs and higher lows and broke both the resistance and the sideways range and the trendline resistance at the same time. This happened at point B. That resulted in a continuation of the uptrend. So this shows the importance of waiting for a breakout in both the trend line and the sideways range for the consolidation pattern to confirm the direction of the trend. So just because price broke below the uptrend line does not necessarily mean that it will reverse downward. You have to respect the horizontal support provided by the consolidation pattern or the sideways pattern. Only if price breaks below that support will you cut your losses and close the position in a long trade. Here's another example of trend continuation. This is the chart of Walt Disney Company at the NYSE. The price chart of Walt Disney Corporation shows a similar price movement to the previously discussed chart of Tesla Corporation. So after price broke below the trend line, it moved sideways. The horizontal support held strongly, pushing prices up within the range until a bullish breakout happened at point A. Price created a higher consolidation range at box B. A short-term trend line was plotted in the chart that connects the price lows within the sideways range. So at point C, the price staged a bearish breakout below the short-term trend line and the sideways pattern. So it plotted a low at point D. However, this appeared to be a bear trap. The bears were not strong enough to follow through for a trend reversal. The bulls pushed the price above point D and then price resumed its uptrend, creating a higher high at point E. So this is the price chart of Singtel Corporation, a telecommunications company listed at the Singapore Stock Exchange. This shows trend continuation. The price was already on a downtrend. It tried to break above the downtrend line at point A. Do we automatically buy into the stock? No, because we have to respect the horizontal resistance. If you see this box, there's a resistance at the left, which should be broken before it can confirm that it is on an uptrend or that it made a trend reversal. So at point A, some traders might have been prompted to enter a long trade. They assumed that the trend line breakout was going to lead to a trend reversal. However, the demand was not strong enough to absorb the supply at the resistance line of the trading range. So the price rally was weak. Price broke below the trend line and the sideways range shown at point B. Price confirmed the bearish breakout by retesting the support as the new resistance and eventually continued to trend downward. So the following illustrates trend continuation in an uptrend after price broke above the resistance line of the sideways trend. In this slide, I would like to introduce a pattern called the coil. The coil is this small box pattern here that formed after the bullish breakout. It is a short-term consolidation pattern that forms above the breakout point. A coil suppresses price. It creates enough energy to push price in the direction of the breakout once the coil is released. So you can liken it to a spring. When you press a spring downward and you release, it bounces. It bounces strongly. So when price broke above the coil, it made higher highs above the breakout point, resulting into a continuation of the uptrend. Now this chart shows a trend continuation in a downtrend. A bearish breakout occurred when price broke below the support of the range. Price retested the previous support as the new resistance, forming a coil just below the breakout point. When price broke below the coil, the downtrend continued. Now let's talk about trend reversals. So this is the price chart of the travelers companies listed at the NYSE. Again, there's a downtrend. Then price broke above the downtrend line. So this shows some strength from the bulls, but the bulls will have to show further strength by pushing above the sideways range. The price started consolidating at the highs of the trading range. It formed a coiling pattern just above the trend line. The price rejection at resistance line was weak, suggesting that the demand is already strengthening. So the supply of shares is also lower because of the higher demands. This was an indication that the probability of the bullish breakout is high. So price eventually broke above the resistance of the sideways trading range and then continued to move higher. This confirms the trend reversal. So previously we showed what pattern occurs in a trend continuation. This diagram shows a trend reversal. So this is a bullish breakout in a trend reversal. First, the price was on a downtrend. Price moved sideways. And then price moved above the sideways range. A coil was formed above the breakout point. It retested the broken resistance as the new support. And then price later broke above the coil and confirmed the reversal of the trend from the downtrend to the uptrend. Now the opposite happens here. The next illustration shows a bearish breakout at the end of a downtrend. Now this illustration shows a bearish breakout at the end of an uptrend. So again, the same thing happened. Price was on an uptrend. It hit resistances, a double top, formed a sideways range. Price broke below the support, formed a coil, and then continued on a trend reversal. I would also like to add that breakouts are more successful if they occur on above average volume, which shows high market conviction. And we talked about this importance of volume in the previous section on how they are found in major turning points. Here's a chart of the PSE index. In this chart, we will see an example of trend continuation and trend reversal. the PSE index had been on an uptrend since 2009 when it formed its bottom, on the way up, it formed consolidation patterns. The blue boxes show these box patterns or the consolidation patterns with resistances at the top and support at the bottom of the box. When price breaks above these consolidation patterns, we can see coils. After this first bullish breakout, the resistance became the new support, and through the coil, price retested that new support many times, forming a smaller box pattern. And then upon a successful breakout above the coil pattern, price moves strongly upward until it meets its new resistance. You will be able to draw support and resistance lines when you connect the tops and the bottoms of a price range, as shown here by the yellow and the red circles. These are called pivot points. When you connect these pivot points, you will find the support and resistance lines that created the new trading range or the new consolidation pattern. So price broke above that consolidation pattern once again when it formed the peak in 2017. However, this proved to be a failed bullish breakout. However, price failed to stay inside that box. It eventually broke below the box and also below the trend line that started in 2009. The PSE had started to form lower lows in terms of price and is currently consolidating inside a box pattern as well. The price had already showed a trend reversal because it broke below the trend line that started in 2009 and peaked in 2017. The price seems to be consolidating at the lows of that new box pattern, so there's a possibility of another bearish breakout from here on. Now, since the PSE index is composed of the biggest companies in the Philippine stock market, I looked into some charts of some blue chips as well. This is the chart of Ayala Corporation. We also can see the same pattern happening in the Ayala chart. Price broke below the downtrend and the sideways consolidation, and then it bounced back, seemingly creating a new sideways pattern. Price is already below the uptrend line that started in 2009, and current prices are consolidating at the low, so it doesn't look too good for the price chart of Ayala Corporation. If it has any chance of bouncing back, it has to go back to the upper part of the box quickly. It has to start retesting the resistance lines rather than the support lines. So this chart looks a little bearish to me. The same as the PSE index, which is likely to move sideways to downwards in the coming months. We can see the same story for the SM Investments chart. Price already broke below the uptrend line, is also consolidating at the lows of the box. This means that the selling pressure is much stronger than the buying pressure, and which could possibly lead to a bearish breakout. Price had been retesting the support line several times, and it had also been trying to break above the uptrend line to go back to an uptrend, but it fails. The AllShares index, which is composed of all the companies in the stock exchange, shows the same kind of weakness. Price is below the trend line and is consolidating at the lows of the price range. So this is a possible bearish breakout. This is the financial index. You can see the same pattern here. The holdings index is showing the same story, a break below the trend line and then a sideways consolidation, a break below the sideways consolidation, and a lower, smaller box. This is the chart of the industrial sector. The dip in price is much stronger than those of other sectors. Now, the same pattern is seen in the properties index. From an uptrend, price made a box. Price tried to break back inside the box, but it failed, forming lower highs. So there could already be a downtrend line in the works, in the property, and in other indexes as well. The services sector had been in a sideways pattern since 2015. So there's no clear direction for this sector as of now. However, we know that it had already ended its uptrend because it is already below the uptrend line. The mining and oil index was starting to look bullish at the end of 2022 because it had been consolidating at the highs of its pattern. And then it proceeded to break above that box, but it seems to be weakening as of now as it had been forming lower highs in price and is now consolidating at the lows of the price range of the new box pattern. I found this article that says that GSIS eyes more investments in mining and infrastructure. So I checked out the chart, and it seems that chart of mining and oil seems lethargic at the moment. It seems to be moving sideways to downwards, although there's also a bullish bias because it already broke above the uptrend line. So there's no need to hurry to get into this investment. We need stronger signals for a possible uptrend or a possible trend reversal for the mining and oil sector. Bitcoin had broken above its downtrend line in the start of 2023 and it started to move sideways, and then it consolidated at the highs of its range pattern. After that bullish breakout, it formed a coil. Within that coil, price had been consolidating at the highs of the price range or the highs of the consolidation pattern. A critical level for Bitcoin right now is the 30 to 32,000 levels, where there is a common pivot point that formed the resistance from the end of 2022 to the start of 2023. Moving averages can be used as trend indicators. We use exponential moving averages lines in order to find the trend. Moving averages are the average of prices over a period of time. The 200 period EMA measures the average of prices over 200 trading days. The 50 EMA measures average of prices over the past 50 trading days, and the 20 EMA measures the average of prices over the past 20 trading days. In this chart, there's a red line that moves across the chart. This is the long-term trend line, which is the 200 EMA line. Now, I added the trend line to show you how moving averages are more representative of price than trend lines. This is because they are more dynamic, they adjust to average prices. This is why they are called true trend lines. If the price bars are below the 200 period EMA line, then the trend is down. It is on a long-term downtrend. If the price bars are above the 200 period EMA line, then the trend is up. It is on a long-term uptrend. This chart shows how prices were on a long-term downtrend from the end of 1997 until 2004. prices were trading below that 200 EMA line. It made a brief crossover in 2004 and stayed above that red line until 2007. Prices dropped back once again below the 200 EMA line. And then in 2009, there was a renewed bullishness when prices started to move strongly above the 200 EMA line. In 2017, so that's about a 9-year period, 8 to 9-year period, prices went below the 200 EMA line again and is currently on a long-term downtrend. The 200 period EMA line is important because it represents the average of prices over 1 year. There are 200 trading days on average within a year, and this line represents the market sentiment over the long term. So if you invested in the stock Ayala Land in 2009-2010, and if you are a long-term investor, you would use the 200 EMA line as support line. As long as price stays above that, you would be holding the stock. Price retested that line several times over the years, but it did not break below that line. In 2017, it finally broke below, and that would be a signal to take profits because the long-term trend is now down. The 200 EMA line, as we said, is the long-term trader support line. The medium-term trader support line is the 50 EMA line. The 50-period EMA line represents the average of prices over 50 trading days, which is roughly a quarter. This reflects medium-term sentiment for the stock, which is probably affected by quarterly reports or quarterly performance as reported by the company. This chart shows the buy and sell signals using the 50-period EMA line. As you can see, there are more entry and exit points using the 50 EMA line because it is more sensitive to price movements than the 200 EMA line because it represents a shorter term moving average. The 50-period EMA line is usually used by swing traders. These are people who probably have day jobs. They don't have the time to monitor the market all day, but they can stomach some volatility in the market, but they also do not want to commit their capital for a very long period of time. So you can just buy and sell stocks using this line. And you don't have to be glued to the market all day. You can just check out the stock price at the end of the day or at the end of the week. And then you make your buy and sell decisions based on that. The 20 EMA line represents the short-term trend. This is the short-term trader support line. This is the green line on this chart. So you can see there are even more entry and exit points using the 20 EMA line than the 50 or the 200 EMA line. So this is for a short-term trader. If price is above the 20 EMA line, the price is on a short-term uptrend. If it is below the 20 EMA line, it is on a short-term downtrend. So this is ideal for momentum traders and for short-term swing traders. Moving averages can also be used as buy and sell signals. If the short-term moving averages are above the long-term moving averages, then you have a bullish crossover. This is a buy signal. If the short-term moving averages are below the long-term moving average, then this is a bearish crossover and it is a sell signal. I'll show you some examples. This is the chart of Ayala Land Inc. Previously, I showed you the 20, 50, and 200-day exponential moving averages on separate charts. This time, we combine these three elements together, or these three moving averages together in one chart. If 20 and 50 EMA are above the 200 EMA, we have a bullish crossover. That means it's a good time to buy because the short-term, medium-term, and long-term sentiments are bullish. Note that the moving averages also have to be pointing upwards. Now, if the 20 EMA and 50 EMA are below the 200 EMA, that is a bearish crossover, that is a sell signal. That means that the short-term, medium-term, and long-term trends are weakening. If the three moving averages are pointing downwards, that is more reason for you to sell because the sentiment is getting bearish. Moving averages can be used as an indicator of volatility. Tighter moving averages mean that the volatility is low. Contracted moving averages are a good time to look into the stock, whether it is time to enter or exit the stock. Now, when the moving average lines are expanded, we know that there's an uptrend or a downtrend ongoing. A good time to enter is to wait for this moving averages to contract. If moving averages are widely separated from each other or there's a huge gap, this is a sign of emotional buying or emotional selling. So you'd rather wait for prices to settle down before entering or exiting the position. You will notice how moving averages tend to contract and expand. When price is moving sideways, moving averages are close together. When price is rallying upward or downward, the moving averages separate and create a huge gap between them. And then when they move sideways again, they reconnect. And then when they create a trend upward or downward, they expand again. So this is what we call the moving average volatility cycle. Moving averages contract and then expand, and then contract and then expand within a market cycle. I'll show you some examples. In this figure, the 10, 20, and 50 EMA lines were used. We used this moving average lines because this is a momentum trade. The moving averages of DEF company had been squeezed together for 20 months, starting from the second half of 2016 to the first half of 2018, as shown in point 1. The sleeping giant had finally woken up in 2018, and the price move was spectacular. The price broke above its buck resistance, along with a moving average bullish crossover at point 2. Price rallied strongly from the low of 135 to a high of 348 within 1 month, from point 2 to 3. The moving averages expanded due to the high volatility in prices. Price then consolidated within a box pattern from July 2018 to November 2018 within the 230 and 360 price range. During this period, demand and supply sorted itself out as volatility contracted. At point 4, the moving averages are in contraction. The price made a false breakout at point 5 that was followed by a strong rebound. There was a bullish moving averages crossover at point 6. The price broke above its resistance at 360, and there was a strong move upward to point 7. The price went to as high as 862 within 7 trading days, and due to the high price volatility, the moving average lines had expanded once again. After that big move that brought price to its 862 peak, price dropped from point 7 and then consolidated inside a box pattern. Price moved sideways as the moving averages contracted. At point 8, the price made a strong breakout, but this time to the downside, causing moving averages to expand. Another example shows the cycle of contraction expansion in moving averages. At point 1, price consolidated for 12 months from July 2014 to July 2015. The price was stuck in a very tight range and the moving averages were contracted or squeezed. Price made a slow upward grind as it prepared to break the box pattern. It consolidated at the highs of the trading range. Then at point 2, the price broke above the trading range while the 10, 20, and 50 EMA lines made a bullish crossover. What followed was a big move that pushed the price from 12 to 24 pesos from September to October 2015. This resulted in a moving average expansion. price consolidated for another 5 months, there's a tight squeeze at point 4 and a bearish moving average crossover followed. This was a sell signal that proved to be a bear trap. After the false bearish signal at point 5, there was a bullish moving average crossover at point 6 that led to another big move. Between point 6 and 7, there was a short pause. At point 7, the price was detached from the moving average lines. This meant that price is trading away from the mean averages and the move is overextended. As expected, price dropped to reattach to the moving average lines. Price bounced at EMA 5 and then consolidated sideways for around 3 months. There was another moving average squeeze, then a bearish moving average crossover. This led to a downtrend afterwards. So this shows the downtrend that followed that move. You notice again the same pattern of contraction and expansion within the downtrend. So there's a squeeze, a crossover, and a big move. So moving averages are also used to determine whether price moves are extreme. If price is forming a gap against the moving average line, then it means that the price move was extreme because moving average lines are supposed to compute for the averages over a period of time. So if price is far away from that line, then the price move is overextended. When this happens, price tends to move back towards the moving average line to reassess itself or to attach itself to the moving average line. We'll see that happening here. When price moves away from the moving average lines, it tends to reconnect later on. This reconnection of price and moving average line brings equilibrium to the chart or to the demand and supply situation in the market. Alright, so we talked about moving average line as well. In later sections, we will be talking about confluences between these indicators in order to have a more optimal entry and exit position.